Good afternoon and welcome to today's webinar. My name is Aneta Buchert and I'm a Senior Director at the Global Institute of Credit Professionals and the host of today's session. The topic of today's webinar is ESG in credit, spotting risks and opportunities, and the webinar is delivered to you by the Global Institute of Credit Professionals. The actual contents of the case study we will be working through are based on the Institute's flagship qualification, the Global Credit Certificate. If you'd like to learn more about the Institute or the certificate, you can visit the Institute website or follow us on LinkedIn. And if you have any questions during today's sessions, please do not hesitate to submit them via the Q&A functionality, and we will respond to them at the end. So without further ado, let me introduce today's guest speaker, Joe Locke. Joe is the Head of Credit Training at Fitch Learning, an ESG expert, and a member of the Syllabus Committee of the Global Institute of Credit Professionals. Joe, over to you.
Thank you very much, Aneta, and thank you for inviting me to lead the session today. Hello, everyone. It's a pleasure to be here with you all. So we're here today to talk about ESG in credit, not ESG in relation to investment, but rather ESG impacting a credit profile or a credit risk for an organization, i.e. impacting the likelihood of default, downgrade, or other credit event. But before we actually start, I'd like to run a very quick poll. So our question is, how much of a company's market value can be attributed to by intangible assets? So brand, ideas, relationships, skills and resources, and the ability to adapt to risks and opportunities related to ESG. And the responses are up to 20%, up to 40%, up to 60%, or up to 80%. And I'll just give you a minute to pop your answer into the poll. So how much of a company's market value can nowadays be attributed to by intangible assets? Okay, I can see the responses coming in thick and fast. Okay, I'm going to close the poll and I'll share with you our results. So you can see here the majority vote goes somewhere between up to 40 and up to 60% in the middle. The answer is actually the last option, up to 80%. And this is according to the Global Association of Risk Professionals. Before the 1990s, 80% of a company's market value was found in tangible assets, such as plant, property, and equipment. But now markets are favouring companies who understand how to measure, manage, and mitigate the intangible risks. And the market's very receptive to businesses that are finding new, unprecedented opportunities in an evolving competitive landscape. So I'll just close the poll and share my screen with you all. And you should be able to see the slide. So here we have our ESG in credit, spotting risks and opportunities. And it's fairly obvious that we want to mitigate the risks and maximise the opportunities. Now, the impacts of ESG can be positive or negative, although as credit analysts, we do tend to focus on the negative. But ESG factors can give rise to opportunities as well as risks. So mitigating the risks and maximising the opportunities is quite obvious. But to understand the ESG risks and opportunities facing a business, analysts need to carry out economic and industry analysis, as well as financial analysis on an individual company. There is a wealth of data available, but not all of it is usable, comparable, and at the moment it's certainly not standardized in terms of format and reporting requirements. And this is one of our key challenges. And we can only mitigate the risks and maximize the opportunities if we firstly identified them. And that in itself is not as easy as it sounds. If we just focus on climate risks and opportunities for a minute as an example, this diagram has been around for a few years now. It dates back to 2017. It's taken from the Task Force on Climate-Related Financial Disclosures report that same year, but it's still very valid. On the left-hand side, we have our risks. We have our transition risks, so business-related risks from economies becoming low carbon or climate friendly. And these may be policy or legal actions, so example from governments to prevent damage or mitigate the impacts of climate change through carbon emissions legislation, for example. They could be from technology, enabling innovation, but at the same time, maybe causing that process of creative destruction, leading to winners and losers. Organizations need to be able to adapt to survive. It's a risk factor. or maybe from the market, so supply and demand shifts for products or for commodities, if we think about lithium for electric vehicle batteries. Also from changes in customer preferences, customers becoming more aware of their own personal impact on the environment. Or maybe even risks from reputation, where we're talking about the perceptions of an organisation's contribution to or detraction from the low carbon transition. And then underneath that, we have our physical risks. And these are the actual risks of climate change itself. These may be acute, so event-driven, for example, floods or hurricanes or forest fires, or they may be chronic, so more gradual, such as rising sea levels, rising temperatures, or biodiversity loss. These risks are unpredictable, and they're very difficult to quantify. On the right-hand side, we can also consider the opportunities that are presented by, in this case, climate change. So we have more efficient resource use, perhaps, and maybe also thereby reducing operating costs and waste, for example. The opportunity to use new, cleaner energy sources, the development of new products or services, or the opening up of new markets, giving access to or creating new revenue sources, new financing sources, for example, green bonds. It can also influence customer preferences or demand for a company's products or services. And finally here, resilience, the opportunity for more efficiency, for new products and new processes within an organisation, for the development of a more robust business that is more resilient to climate change. And fundamentally, it's the impacts of the climate-related issues on an organisation that are driven by these specific risks and opportunities. And it's the organisation's strategic planning and risk management who manage those risks and seize those opportunities to determine the impact of them. Now, in order to make more informed decisions, investors, lenders, and insurance underwriters need to understand how climate-related, in this case, or indeed any ESG risks and opportunities are likely to impact an organisation's future position and financial standing, as reflected in its income statement, its cash flow statement, and its balance sheet. And this in turn may determine or contribute to that organisation's creditworthiness and business viability. We could also recreate this diagram for social risks, so changes in social policy, in market sentiment, human rights breaches by an organisation, or worker exploitation in supply chains. In terms of social opportunities, we might think about better employee well-being, positive impacts on communities, more diverse organisations, better education levels in society, and higher productivity. Or we could draw it up for governance risks, the risks of not complying with legislation or codes of conduct, or weak overall governance in an organisation. The management and the board have a requirement to manage all material risks of that organisation in question. That includes ESG risks. And there is potential litigation as a consequence of failing to do that. In terms of opportunities from a governance perspective, we can talk about better disclosure, higher levels of transparency, boosting investor and market confidence. So ultimately, again, it comes down to strategic planning and risk management to mitigate those risks, capitalise on those opportunities for a stronger, more resilient and more profitable business over the long term. So how do we go about spotting those risks and opportunities in our work? Well, we have a case study now for Company X, as it shall be known. This is one of the companies, as Annetta mentioned, is used in the Global Credit Certificate course and is particularly a focus in the examination at the end. So this is a good one to pay attention to. And in the company's own words, they say, as a growing and ageing world population requires an adequate supply of food and improved medical care. With our innovative products, we are contributing to finding solutions to some of the major challenges of our time. With life expectancy continuing to rise, we improve quality of life for a growing population by focusing our research and development activities on preventing, alleviating, and treating diseases. We are also making an important contribution to providing a reliable supply of high-quality food, feed, and plant-based raw materials. The group is managed as a life science company with 3 divisions. pharmaceuticals, consumer health, and crop science. And as a proportion of their 2021 EBITDA of €10 billion, 50% of that is in the pharmaceuticals business, 10% in consumer health, and 40% in the crop science business. The company's internal targets are fully in step with the United Nations Sustainable Development Goals and the climate targets of the Paris Agreement. And sustainability targets are part of the variable compensation of the Board of Management. So let's have another poll now. And this poll question, given what we know about Company X so far, which ESG factor is, in your view, the most relevant to this business model in terms of the risks and opportunities that it presents? Okay, I'll end the poll, share the results. And we can see that the winner in this poll, if you like, is the social factor, followed by environmental, and then followed by governance. So 53% of you voting for social, 32% for environmental, and 15% for governance. So let's start to think about those ESG considerations. Do we need to consider environmental factors? Are they relevant? And if so, which ones might we be thinking about? Which business areas might be impacted? Now, environmental factors have become a major consideration in recent years due to a combination of population growth, the increasing scarcity of raw materials, and the impact of pollution on global warming. We are seeing regulatory change as governments impose pollution targets and carbon footprint targets in an effort to tackle climate change, and these policies have greater impacts on certain industries, such as farming and agriculture. So crop science here, and also consumer health in terms of waste packaging and recycling. What about the social factors? Well, the risks around the global pharmaceutical sector remain high, particularly around regulatory and political interventions, and also continued mergers and acquisitions. Political uncertainty affecting the sector is particularly high in the US, where the affordability debate around healthcare and a particular focus on drug prices within that is actually intensifying. Social pressure to contain healthcare costs is also a relevant consideration. Regulation risk in the pharmaceutical sector is high, and the regulation of drug prices would have a negative impact on earnings. What about governance factors, though? This is a German company, so I'll give you a clue, and therefore it's subjected to the German Corporate Governance Code. Management have a requirement to manage all material risks, including ESG risks. So the governance is very relevant here too. Effective and sustainable corporate governance also encompasses the effective management of the environmental and the social risks throughout the organisation. It's all interwoven. So it's difficult to know where to start, as there are so many factors, and we don't know how important or relevant they are. And to be efficient with our time, we can't investigate every possible option from scratch. It may become apparent that the company is exposed to a large number of ESG risks, but we need to assess their materiality. How important are they? In doing this, we may use our own experience and we may use that of our colleagues. But another way to understand and to make judgments on materiality is to use some tools. And these identify likely material sustainability issues on an industry by industry basis. This is just one of those useful tools, and some of you may already be familiar with this. This is from the Sustainability Accounting Standards Board and includes the full spectrum of E, S and G risks. It's also included in the ESG chapter syllabus for the Global Credit Committee. So this is the universe of sustainability issues as defined by the SASB, formerly known as the materiality map. And we can use this to identify the roots of those risks and opportunities. This interactive tool, available on the SASB website, with a link in the bottom corner for you there, identifies material sustainability issues on an industry by industry basis. It ranks 26 different sustainability related business issues, as you can see around this slide, across various different sectors and types of institution, according to whether the particular issue is material for more or less than 50% of companies in that sector. The 26 different factors are categorized into 5 sustainability dimensions: environment, social capital, human capital, business model and innovation, and leadership and governance. I really would encourage you to take a look on the website, as it is incredibly useful, particularly for those of you that are assessing the different corporate sectors. So let's see how this works for our case study, Company X. Now, recall the company has 3 areas of business: pharmaceuticals, consumer health, and crop science. The first 2 areas are covered here, with the bold issues in this table being identified as relevant for this sector. The non-bold areas are areas that SASB has not identified as most likely to impact enterprise value at the current time, though of course this may change with new incoming legislation or policy changes. As we know, this is a fast-moving area. Crop science is covered on the next slide, and we might see some E-related factors and considerations there too. So the issues in black text are therefore where it is most likely that the risks and opportunities will lie for Company X. Let's take a closer look. So if we take access and affordability as an example of an opportunity, Company X has been working on improving access and affordability of contraception for 100 million women in low and middle income countries by 2030, thus enabling those people to remain in education, fulfill their potential, and contribute as workers rather than having a family earlier than they may have wished for, which can take them out of the workforce. Boosting education, boosting equality, and ultimately boosting productivity of the labour force in those countries. If we think about consumer welfare or customer welfare, this is an area where there are potential risks for Company X, particularly relating to drug safety, clinical trials, and the company's ability to prevent or manage counterfeit versions of its drugs and medications. Company X has been using artificial intelligence since 2019 to analyse large volumes of data from drug trials and clinical trials. This enables side effects to be discovered at an earlier stage and risk mitigation measures to be implemented faster, which in turn helps to further improve patient safety, mitigating risks, and capitalising on opportunities presented by new technology. If we move on to the agricultural products sector, so this is where we're talking about the crop science business, we can see that there are some relevant E factors here too: greenhouse gas emissions, energy management, and wastewater management. Specifically for Company X, product quality and safety is a key issue. There is a negative public perception of this particular company. This represents a key ESG risk. In crop science, modern agricultural methods, such as the application of certain crop protection products and the use of genetic engineering, are often the subject of intense public debate and can adversely affect the company's reputation. This company has been in material litigation in the US regarding the use of glyphosate in some of its products. This is a herbicide and a relatively commonly found weed killer. The legal claims are that this product has caused or causes a type of cancer. Multiple cases are ongoing, and we won't be discussing the legal intricacies of it here, but it's a good example of a key risk that could significantly affect the credit profile of Company X. In the 2021 annual report, the company has set aside $7.5 billion in litigation provisions, and this has impacted earnings, the share price, and investor confidence in the company, as you can well imagine. So this is a key material risk. Moving on, one of the company's specified targets is to support 100 million smallholder farmers in low middle income countries. This could actually fall under a couple of different categories here, but we've classified it under material sourcing and efficiency, i.e. maximising resource efficiency. Farming is often the main source of income in these types of countries, and food scarcity and poverty is a big issue. Supporting farmers can have multiple benefits. Using new technology such as drones and satellite monitoring, they can target the use of water, the use of crop fertilizer, and be more effective with scarce resources, thus improving production and limiting crop wastage. Now, the next step in our process would be to assess the impact of these risks and opportunities. not only from a financial or profitability perspective, as is the more traditional approach, but also from the impact that these initiatives have on people, the communities, and the planet as well. This is much more difficult to quantify. So I have our final poll for you now. So that given what we have found out about Company X, and on a scale of 1 to 5, where 1 is high risk and 5 is high opportunity, where would you position this company in relation to the risk and opportunity from an ESG perspective? I'll just open the poll now. It's a very mixed bag. 36% of you say moderate risk, 22% moderate opportunity, 18% high risk, 16% high opportunity, and 9% have gone with the neutral option of number 3. Okay, interesting. So slightly more on the risk side than on the opportunity side. Interestingly, back in January, this company was identified as a good opportunity for ESG investment by a US activist investor who considers that crop science division is a jewel in the crown with regard to world food shortages and helping to eradicate food poverty. I also have a screenshot here from Bloomberg. And this gives a nice, concise summary and relative rankings, progress or achievements against some of the factors that we've been looking at today. We can then also use this as a basis for our peer comparison, which is a key part of any credit analysis. We also have a number of tabs along the top of the screen. You can find out plenty more information on the company, which could potentially be useful for things like stress testing. So I'm going to leave you with that as food for further thought. The data in relation to ESG risks and opportunities is definitely improving. This is an example of how it's becoming much more usable and much more user-friendly. It's just not progressing quite as quickly as many of us would like. So we've just had a bit of a whirlwind workshop on spotting ESG risks and opportunities, but this has only been the tip of the iceberg. There are plenty more to spot and assess under the surface. Much of the material that we've covered today ties back to the GCC syllabus. It's covered in the chapter about ESG and credit, in which there are 5 key learning areas. We give an ESG overview and talk about market engagement. We look at sustainable finance and ESG-related debt. We look at ESG regulation and reporting frameworks. We look at ESG integration into decision-making and ESG application examples. And today, we skipped straight into the integration into decision-making stage and applied the concepts with the use of a practical example. A sample of the syllabus for the GCC is shown here on the right-hand side of the slide. All the different areas that are covered in our syllabus, you can see last but not quite the bottom one, the next one up, ESG and credit on there. And we're running this webinar today to increase awareness of the Global Institute of Credit Professionals and the flagship certification, the Global Credit Certificate, a qualification that has been specifically designed for credit professionals. I almost wish that this had been in existence 20 years ago when I started my career in credit risk management. And the GCC consists of studying for and taking 2 exams, which lead to the certification that then opens the door to the Global Institute of Credit Professionals membership. And the GICP then gives access to lifelong learning opportunities, to thought leadership from our industry experts and selected third parties, to a wealth of career resources, access to a network of like-minded professionals, and access to a number of interesting events, such as webinars like this one today. For more information, you have the URL and the QR code and LinkedIn details if you would like to follow on LinkedIn. If anyone would like to take a screenshot or capture the link, please feel free. I hope you've enjoyed this session. And now I'll hand back to Annette for any questions that have been submitted. Thank you.
So just as a reminder, if you have any questions, you can submit them via the Q&A functionality, and we will try to answer as many of them as possible. And let me see if we have any questions submitted so far. There is the first one. The first question, Joe, is what are some of the best practices for incorporating ESG factors into credit analysis?
So I think it's very important to take a holistic view of this, not a siloed approach. So ESG factors impact every area of our credit analysis. We can't just treat them as kind of a side add-on. We do our normal credit analysis and then we quickly look and see if there's anything ESG related that might be an impact here. ESG affects every single aspect of our credit analysis. If we think about assessing banks, we're looking at banks' capital. Well, ESG can have an impact there. We look at asset quality, we can have impact on asset quality. We need to look at how management are dealing with these issues. ESG can have an impact on earnings. It can have an impact on funding and liquidity as well. So it cuts across all the areas of credit analysis, cannot be treated just alone on the sidelines.
What types of ESG data and information do credit analysts typically use to evaluate an issuer's ESG performance?
In terms of information, in one way we're spoiled because there's quite a lot of information out there. But on the other hand, we're not, because a lot of that information is quite difficult to use. So we can see companies now are publishing sustainability reports, they're publishing their annual reports with data in that, they're publishing TCFD reports, rating agency reports. So there's lots of information and research out there in the market. But the problem that we have is that none of this data is uniform and none of it is standardized at the moment. We are making progress in that regard, but for the moment, we are flooded with a lot of data and information, and it's really key to be able to pick out the useful parts of that, because we don't have all the time in the world to do our ESG analysis.
Thank you, Joe. So the next question we have is, the poll at the end was very interesting in terms of dispersion. What does this tell you about evaluating ESG factors in credit analysis?
That is a very good question. So what would I say to that? Well, when you're looking at ESG assessments, we talk about the concept of materiality. So how important is that ESG factor, or how are those ESG factors to an organization? Not everybody's assessment of materiality is the same. Some people see some issues as bigger risks than others. And there's much more dispersion in the ESG assessment than there is in a credit assessment. Credit assessments are based much more on numerical values, on ratios, on comparisons over time, and trend analysis. We don't have that necessarily in ESG to the same degree, so we expect more dispersion. So actually that poll has just demonstrated that as well. People view things very differently in the ESG world.
Another question we have is, can you provide a recent example where ESG factors played a significant role in the rating decision?
I've got a couple that spring to mind. So there's a natural resources company in Brazil called Vale, or Vale if you're going to pronounce it the Portuguese way. And this natural resources company had a number of dams. And in 2016 and 2019, two of their dams failed. And those dams then spilled mud and mining waste, because mining waste had been kind of buried in the construction of the dam, spilled mud and mining waste into nearby villages and the countryside. And actually it was a tragedy because over 300 people died, including some of the workers of the company itself. Huge amounts of ecological damage. And the company was downgraded from BBB+ to BBB- in 2019. And the drivers of that were the waste management, so the ecological impact, employee well-being in terms of worker safety, and two governance factors: management strategy, so why were they building dams with mining waste, and the group structure was very complex. They had operations in a number of different countries, they were subjected to different regulations and very low transparency across the organisation as to how they were managing some of the risks of their business. So that's one. Another one that people may be a little bit more familiar with is a Swiss bank. Credit Suisse has been downgraded to BBB flat, I think in August last year, due to governance reasons. So the operational implementation of their strategy and their restructuring, and the legal and compliance risks that are currently under investigation or being dealt with at the bank. So they had a strategic review, they've got significant execution risk, and that in itself has an earnings impact as well. So from a governance perspective, this is where the banks are likely to see issues.
So the next question we have is, how useful do you believe is the Bloomberg ESG screen for credit analysts. And do you feel there's a difference in approach and evaluation between credit and equity analysts?
That Bloomberg screen can be useful if it covers the company that you want it to cover, because it doesn't cover everybody. So if it covers your companies, then yes, obviously it's going to be quite a good way of standardizing information, because that's where we're really struggling from an ESG perspective. We're getting comparable and standard information to do a peer group analysis. So it does help in that regard. Compared to equity analyst view, I think equity analysts are looking for upside and growth in their investments. Credit analysts are looking more from a business viability perspective. And as I said earlier on, we tend to be more focused on the negative, on the risk side of things. So we need to consciously open our eyes to the opportunities, but we are focused on business viability, whereas the equity analysts are more focused on return.
Thank you, Joe. So the next question from Alisa is, do you consider climate-related issues factors as part of the E in ESG?
I think in the broader scope of things, they are part of the E. In a way, climate has overshadowed everything else that could be included in the E. Climate is the area of focus at the moment. This is where the regulators are looking. If we're looking at stress testing, particularly in the banking system, this is relating to climate. So climate is the big area, I'd say, where everybody is worried about at the moment, but that doesn't mean that it's the main risk. There are a lot of other risks tied in with ESG as well that we also need to be monitoring and managing.
How do you balance ESG considerations with traditional credit metrics when evaluating an issuer's creditworthiness?
So how do we balance ESG considerations with our traditional credit metrics? Well, one way is to look at the ESG factors in terms of their relevance or their importance or how material they are to those credit metrics. So are those ESG factors enough to move the needle in terms of our credit analysis? So if I give you an example, if we have a company that develops a new product that customers, that very eco-conscious customers like and buy, that's going to increase revenues for that company. So that would then increase their earnings and their profitability, drive higher returns. So that could give an uplift for creditworthiness for a company. So that would be an example there. But it's looking at how relevant these factors are. Are they enough to move the needle? But the thing we need to really think about is, are they enough to move the needle in the longer term? So our traditional credit analysis has probably gone out 1, 2, maybe 3 years, a bit longer if we've got longer exposure to a particular customer or company. But from a sustainability perspective, we need to be looking at 10, 15, 20, 25 years and pulling out that time frame. And that's what we haven't done traditionally in the world of credit analysis.
Joe, the next question is, how do you see the importance of ESG factors evolving in credit analysis?
How do I see them evolving? Well, there's a few skeptics out there that say, oh, it's ESG, we don't really need to worry about it, it's not a big thing. Now, unfortunately, the regulator does not agree with that, and the regulator is looking at ESG factors. So if you're a regulated institution, you have to deal with this. Okay, so the importance of ESG factors evolving, yes, it's very important. In order to green the financial system, the central banks are really following now how banks are grappling with climate risk issues. They're stress testing banks' portfolios in relation to climate risk. There's a potential for additional capital requirements for banks that are either carrying higher risks in terms of climate risk or are not good at disclosing, modelling and managing the risks that they do have. So I can only see that role growing really over the next few years.
Joe, so we've spoken about incorporating ESG into credit analysis. Now the question is, can you speak to any challenges or limitations of incorporating ESG factors into credit analysis?
I think we talked about that a little bit already when we looked at the information that we have. We saw risks and opportunities, difficult to quantify them, difficult to measure the impact of them. And that's not just now, but that is into the future as well. So the limitations of incorporating those factors into our credit analysis is we need to look at how that's going to change the business model over a longer period of time. And we don't necessarily have the data to be able to do that. If we think about our financial analysis, but we've got years and years of history of financial data we can draw back on. We don't have any of that for ESG. We're very much trying to find out, pick trends for things that are going to happen in the future, but we don't have the historical backing for that.
So the next question is, do you put a monetary value on each ESG factor risk opportunity? Some are rather ephemeral, resulting in far more subjectivity than is present in traditional credit analysis. How do you balance this as a credit analyst?
So can we put a monetary value on it? Well, if we look at company X, so some of those risks and opportunities we talked about, we could put a monetary value on. So we looked at the litigation risk in the US, $7.5 billion. That's obviously quite a lot of money. But if you think about what the company's doing to support the farmers, how do you put a monetary value on that? Because you're supporting farmers, you're then making food production more efficient, you're then meeting the Sustainable Development Goals of no more poverty, you're bringing people out of food poverty, you're also creating more jobs for farmers and agriculture as well, because you're being more efficient with the resources that you're using. How do you put a monetary value on that? I mean, that's where we're all really grappling. We haven't got the ability to do that at the moment. And again, what is the benefit of that to those communities, to those people? That's something that's going to pay dividends for years into the future. But can we actually quantify that right now? I don't think we can.
So the next question is, what difference will it make to the credit process once most companies are disclosing their transition plans under forthcoming guidance?
I think it is something that we are eagerly awaiting. Now, in terms of building that into our credit analysis process, we may have to start to refine some of our credit analysis models to do that. And that's something at the moment that we're not really seeing in the market. So we're still seeing the traditional credit analysis model with maybe an override relating to the magnitude of the ESG risks facing an organization. So once we get more standardized disclosures, we should be able to have a more comprehensive assessment process incorporating those ESG factors throughout our credit analysis, rather than having it as an up or downgrade option at the end of your risk rating model, for example. But having said that, the legislation and the regulations that are coming in are coming in for companies of a certain size, particularly in the European Union. That we may have banks and companies that are very small, and banks that have client bases of very small companies that either aren't subject to the legislation, so they don't have to report and disclose the same amount of information, or just simply can't do it. Think about small and medium-sized enterprises. They're not going to have a sustainability specialist person in that organization. So I think this is something, again, that we're going to have to find a way to work around this for those smaller organizations that are not able to disclose. But when standard disclosure comes in, I think there'll be a few people that'll be very happy in this world.
Thank you very much, Jo. That was our last question, and we are coming to the end of the session. Thank you very much for your participation. Thank you very much for all of your questions. Details of further events hosted by the Global Institute of Credit Professionals will be available on the website and on the LinkedIn page. So if you're interested, please do check both. And again, thank you very much for your participation today, and have a great day.